Well, as much as the same as the month of September, with most of the return coming from global equities, with the index generating a return of 5.3% in New Zealand dollars. That's over 17% in the last 6 months. New Zealand equities etched out a much more modest 2.8%, a monthly return that most investors would be very happy with in normal market conditions. So markets have basically been driven by AI at the moment, and to a lesser extent gold. It's basically been the same story for the last 18 months. We've been saying for a while that we're getting a bit concerned about the valuation of the sector. As an example, OpenAI staff recently sold some shares, which valued the company at 860 billion New Zealand dollars. That's up from 520 billion only early on in this year. This is for a business that is losing $14 billion a year on revenue of 22 billion. As a comparison, Fisher & Paykel Healthcare has a market capitalization of 20 billion and made a profit of nearly 380 million last year. While OpenAI is a private company, it highlights how many in the sector are priced to perfection. And while we continue to have exposure, 48% of our growth fund, for example, is invested in global equities, which is below our neutral long-term target of 52%. We feel there's a real risk that money being invested into the sector will not generate the returns that have been expected and could result in a significant derating of many of these AI darlings. As they say, the key is not whether to get on the train, it's knowing when to get off. And we really believe at the moment diversification is key. Our investment approach is to bias the portfolios to areas where we believe we're getting better compensated for taking risk. As an example, we're currently overweight in New Zealand equities. We believe with the dropping in the OCR, the overnight cash rate, and resulting in a weaker New Zealand dollar, this is going to benefit many companies on the New Zealand share market. In addition, as people move out of lower yielding bank deposits and into the high yielding utility stocks, these utility stocks will get a re-rating as well. We also have a slight overweight to global listed infrastructure. Global listed infrastructure is actually trading as cheaper as it ever has to world global equities. But also it has a couple of other attractive features. One is it will benefit from unexpected inflation. And two, it has a very large exposure to power utilities, which, as we know, the demand for power is expected to increase dramatically over the next few years. And finally, we have an overweight to private credit. This is businesses that lend to small, medium-sized businesses, while generating a return of 8%, which doesn't look attractive when global equities are doing 20% plus. It's taken substantially less risk, and this will benefit if there is a derating of global equities. So while we're taking on a lower level of risk in our portfolio, we're still generating very competitive returns. For example, our growth fund did 2.7% for the month and over 4.7% for the quarter. The key now is to remain disciplined and not chase returns. That's the secret to delivering on our desire to have a smoother journey, but the same destination.